A couple of months ago, there was a lot of concern about rising interest rates, which caused a big market shakeup, and experts feared it could lead to an economic crisis. Interestingly, the anticipated recession has yet to happen. Companies have been doing better than we thought, with their earnings showing a robust 4% growth in the first quarter, double what was predicted. However, there are still some concerns about the economy's health. So, as you think about investing this year, it's essential to pick the best investment options and recognize and avoid the riskier ones. Some investments seem great, but they may pose significant risks that could jeopardize your financial security. Fortunately, in today's video, I'll guide you through the top 10 investments you should avoid this year. So without wasting any time, let's get started. Number 1. Annuities. Annuities come in two primary forms, fixed and variable. In a fixed annuity, you give money to an insurance company. In return, they promise to provide a set income for a specific duration or your whole life. On the other hand, a variable annuity involves putting your money in investments similar to mutual funds. This means your income can vary, giving you more or less money than a fixed annuity. So why are annuities not a good choice? While they might be suitable for a few investors, many can achieve the same goals using different investments without the downsides of annuities. These downsides include high fees and steep charges, which can be around 7% if you decide to take out your money soon after investing. Additionally, just like with IRAs, you can't pull out your money from an annuity before you're 59 and a half years old without getting hit with tax penalties. Number 2. Penny stocks. According to the U.S. Securities and Exchange Commission, penny stocks are shares of small companies that trade for less than $5 each. But often on Wall Street, when people talk about penny stocks, they refer to those trading for under $1. The allure of penny stocks for many investors is their low cost. Even a slight increase in the stock's price can result in significant returns. For instance, if you purchase a penny stock at 50 cents and its value rises by 10 cents, you've made a 20% profit. Impressive, right? So why are they on this list? Generally, their low prices reflect struggling companies that might be nearing bankruptcy. The world of penny stocks is rife with market manipulation. Some promoters might hype up a specific penny stock claiming it's the next big thing to increase their price. They sell their shares once the price is up, making a profit. While penny stocks can be tempting due to their potential for high returns, they are speculative. They can be heavily manipulated, making them a risky investment choice. Number 3. High yield bonds. Bonds are like IOUs. You lend money to a company, and in return, they promise to pay you back with interest. However, not all bonds are created equal. Some are riskier, and these are often called high yield or junk bonds. Moreover, credit agencies usually rate these bonds lower, indicating that the company is more likely to default on its debt. In the investment world, more significant risks often promise greater rewards. So when many investments yield low returns, high yield bonds tempt investors due to the potential for better profits despite the risk. Just as people with low credit scores are deemed risky by banks, companies with low credit ratings are also considered dangerous to investors. If you invest in a bond from a low-rated company, it goes bankrupt and you could lose your entire investment. It's also tricky for individual investors to gather enough detailed information to fully assess a company's health, making it challenging to pick a reliable high-yield bond. While purchasing these bonds through mutual funds can reduce the risk, it doesn't make it disappear entirely. Number 4. Private placements. Private placements are special stock sales from companies not listed on public stock exchanges. To invest in these, you need to be an accredited investor. According to the U.S. Securities and Exchange Commission, an accredited investor should have an income over $200,000 or $300,000 with a spouse in the past 2 years and expect the same in the same year. Alternatively, having a net worth of over $1 million qualifies you as an accredited investor. This investment route is open to some. While genuine private placement opportunities exist, they might only suit some investors best. For many, obtaining enough information to determine their worthiness is challenging. Similar to the risks of penny stocks, there's a chance of being misled. Some promoters may need to emphasize the potential gains, sidelining the associated risks. Another drawback is the potential difficulty of selling these investments. If major investors or company insiders sell their shares first, others might find themselves holding a depreciating asset. Number 5. The lottery. Lotteries are very popular across the US. Almost every state has its version. Becoming an instant millionaire with a small investment, like buying a $1 or $2 ticket, can be very appealing. This fascination is further heightened when we see winners celebrated in the media, making it seem like anyone could win. However, when we delve into the odds of winning, the reality paints a very different picture. Take the Powerball lottery, for instance. The chances of securing its jackpot are approximately 1 in 292 million. This means you have a better chance of discovering a pearl in an oyster or even getting struck by lightning than winning the Powerball. Generally, when it comes to lotteries or gambling, the chances of winning big are incredibly slim, almost like hunting for a needle in a haystack. Over time, you'll likely spend more on tickets than you ever win. The money you could have invested or saved. While dreaming of a big win is fun, it can lead to unhealthy spending habits or addiction. Moreover, if you get lucky and win, taxes will take up a considerable portion depending on your state. While playing the lottery occasionally for fun is fine, it is not a reliable or sensible way to invest money or plan for financial growth. Number 6. Currency trading. Currency trading, often referred to as forex trading, is not recommended for beginners due to its complex nature and rapid rate fluctuations. Such a fast-paced environment can pose significant risks, especially to those who trade based on emotions or limited knowledge. Experienced investors in this business often study specific currency patterns to minimize risks. A common strategy they employ is simultaneously selling one currency while buying another. Given the interconnected currency markets, this tactic helps protect their investments against potential losses. The forex market is also known for allowing high leverage, which means you can handle a large amount of currency with just a tiny amount of money. Brokers usually offer high leverage, like 50 to 1. This technique can increase profits and magnify losses. So, using leverage needs careful thought and understanding. Number 7. Fallen angels. A fallen angel refers to a stock or bond that was once doing well but has significantly dropped in value. In bonds, it's when a company that used to have a high credit rating is now considered junk. For stocks, it's those that were once thriving but are now struggling. People sometimes get attracted to them, hoping they'll recover and return to their glory days. Stocks that experience such significant declines are also called falling knives. This suggests that just like trying to catch a knife in midair, attempting to invest in plummeting stocks might lead to harm. For instance, Many stocks that lose 50% of their value might continue to decline, dropping by 70, 80, or even 100% of their initial worth. Since predicting the exact bottom of a stock's decline is challenging, it's wiser to wait and invest when there's evidence of consistent improvement. Only then can the stock shift from a risky choice to a promising investment. Number 8. Airline stocks. Airline stocks represent some of the world's most recognizable brands, especially for frequent travelers. Names like Delta, JetBlue, American, United, Southwest, and others are all publicly traded. While the COVID-19 downturn severely impacted the airline sector, it's worth noting that even before this crisis, airline stocks carried substantial investment risks. In 2013, billionaire Warren Buffett called airlines a death trap for investors. However, he later changed his stance and secured a dominant shareholder position in leading airlines like Delta, Southwest, United, and American. Interestingly, Buffett has reverted to his initial view as a report by CNBC revealed that Berkshire Hathaway had sold the entirety of its equity position in the U.S. airline sector. Over the years, several leading airlines have experienced financial challenges. This includes significant names like United, TWA, Delta, US Airways, Pan Am, and Northwest. This history highlights the unpredictable nature of this industry. Even when airlines seem to be doing well financially, they remain vulnerable to unexpected downturns, especially in light of recent global events. Number 9. Cryptocurrency. Cryptocurrency is a form of digital currency that has captured the attention of investors over the past 14 years. However, it's considered one of the riskiest possible investments. This is mainly because most cryptocurrencies like Bitcoin and Ethereum do not have a physical form or real value like gold or silver. Their value is primarily determined by what investors believe they are worth, a concept called investor sentiment. When people are optimistic about these digital currencies, their prices rise. But when investors lose faith or become pessimistic, prices may fall. The unpredictable nature of cryptocurrencies is further highlighted by the fact that Bitcoin and Ethereum, two of the most popular cryptocurrencies, are trading at values 60% lower than their highest recorded prices. By April 2023, despite past surges in value, these two digital currencies have seen significant reductions from their peaks. This indicates the level of risk and volatility one should expect when dealing with cryptocurrencies. Even legendary investor Warren Buffett has reservations about cryptocurrency. At a recent annual meeting for his company, Berkshire Hathaway, Buffett commented on the unpredictable nature of this asset's value. He revealed that he couldn't confidently predict whether its value would go up or down in the short term or over the following 5 or 10 years. But one thing Buffett was sure about was the asset's inability to produce tangible results. An asset should provide some concrete benefit or output to be deemed valuable. In other words, if someone is investing in something, that thing should have a clear, understandable value or a way it contributes positively. Cryptocurrency, in Buffett's opinion, does not meet this criterion. And lastly, number 10, the Nigerian Prince. Imagine one day you find an email from someone claiming to be a Nigerian prince. This so-called prince is in distress and urgently needs your help. He claims to have a vast fortune that's somehow inaccessible, and he promises you a large share of it, but only if you send him some money first. The story might change slightly, needing money for fines, administrative fees, or bribes. But the essence remains: send money now to get more money later. Do not fall for this. There's no such thing as easy money. This type of scam, often known as the Nigerian Prince or the 419 scam, is among the earliest and most recognized email frauds. While many people today recognize it for what it is, a hoax, fraudsters have evolved their tactics. Newer versions might not just ask for money. They could request your bank details, pretend to be you to commit financial fraud, or even fake romantic interest to manipulate you into funding for their travel or immigration costs. If you ever get unsolicited economic proposals, approach that situation with caution. Always be skeptical, even if the offer comes from a reputable source. Before making any commitments, consult with a financial advisor. Never share your personal or financial information with unverified individuals or entities. Well, that's it for this video. Thank you so much for watching. Until next time, have a great day.